Hello, my name is Alex Choi. I was born in South Korea and currently live in the United States, where I studied economics at top-tier universities. On this channel, I'll be sharing my knowledge and insights into global markets and financial systems. And since this is a new channel, your support by subscribing and liking the video truly means a lot. Now, let's move on to today's topic. Japan just did something that has not happened in nearly 40 years, and almost nobody understands how serious this is. What happened in Japan is not just a local political decision, it is not just a bond market story, and it is definitely not contained to one country. This is the first domino in a global chain reaction that has played out again and again throughout modern financial history, and every time this sequence starts, it ends the same way, with massive asset liquidations, violent repricing, and a transfer of wealth that most people never see coming. Here is what actually happened and why it matters for every investor, every retirement account, and every portfolio on the planet. On January 20th, 2026, Japan's prime minister called a snap election for February 8th, just days away. And during that announcement, she made a promise that sounded extremely popular: suspend the 8% consumption tax on food, increase government spending, more stimulus, more benefits. On the surface, it sounded like relief for households, but bond markets heard something very different. Japan already has the highest debt burden in the developed world. Japan's debt to GDP ratio is approximately 237%. For comparison, the United States is around 125%, and that level is already considered dangerous by many economists. Japan is almost double that. And yet, the government just promised lower taxes and higher spending with no clear funding source. That means more borrowing, more bond issuance, more pressure on a system that is already stretched to the limit, and bond markets reacted immediately. On January 21st, the Japanese government bond market experienced one of the most violent repricings in decades. The 40-year Japanese government bond yield surged by roughly 25 basis points in a single session. That is not normal volatility. In that market, yields typically move by fractions of a basis point per day. Sometimes it takes months to move 10 basis points. They moved 25 basis points in hours. The 30-year yield jumped around 30 basis points, reaching approximately 3.9%, the highest level ever recorded. The 10-year yield moved to about 2.35%, the highest level since 1999. And all of this happened in one day. This was the most aggressive sovereign bond repricing Japan has seen since the late 1990s. And here is the part most people missed. This was not just a Japan problem. Japan is the world's fourth largest economy. Japan holds over $1 trillion in U.S. Treasury securities. They are the largest foreign holder of American debt. When yields spike in Japan, Japanese investors suddenly have a reason to move capital back home. Why buy U.S. Treasuries at around 4% when Japanese government bonds are offering similar yields in local currency with no exchange rate risk? So what happens next? They sell U.S. bonds. And when the largest foreign buyer of U.S. debt becomes a seller, U.S. yields rise. That is exactly what started happening. U.S. 10-year Treasury yields jumped in the days following the Japan shock. The 30-year moved even more. And this is how contagion starts. Not through panic headlines, but through mechanical capital flows. And once yields rise, they don't just affect bonds, they affect everything. Stocks, real estate, corporate credit, private equity. Every financial asset is priced relative to so-called risk-free rates. When those rates rise quickly, valuations fall, and that is why analysts are talking about $4 trillion in forced liquidations as a conservative estimate, not a possibility. A floor. And if this sequence fully unfolds, the total liquidation could easily reach $6 to $8 trillion globally. This is not speculation. This is pattern recognition. And the pattern is very clear. There's a four-stage sequence that repeats every time a developed economy loses control of its debt markets. Stage 1 is the setup. This is where debt grows beyond sustainable levels, not just high debt, but debt that becomes extremely sensitive to small changes in interest rates. Japan spent 3 decades building this setup. Deficit spending, stimulus packages that failed to produce lasting growth, entitlements that could not be funded through taxation. The result was a debt load of roughly $13 trillion and a debt-to-GDP ratio of 237%. Stage 2 is dependency. This is where the government becomes completely dependent on low yields. Because if yields rise even modestly, interest costs explode. At 1% interest, Japan pays roughly $130 billion per year in interest. At 4%, that jumps to more than $500 billion. That is close to a quarter of the government's entire budget just to service interest. This is why the Bank of Japan implemented yield curve control and massive bond buying programs. For years, the central bank suppressed yields artificially, and it worked. Markets stayed calm. People believed it was sustainable. Stage 3 is the break. This is where confidence snaps. Sometimes it is triggered by a political announcement, sometimes by a policy shift, sometimes by a weak bond auction. It does not matter what the trigger is. What matters is psychology. When investors start questioning sustainability, bond markets reprice violently. Because bonds are highly leveraged markets with enormous scale, when selling begins, it feeds on itself. Yields rise, prices fall, margin calls appear, more selling follows. Stage 4 is contagion. This is where the crisis spreads globally. Because modern financial markets are deeply interconnected, when Japanese yields spike, US yields follow. When US yields rise, European yields rise. Currencies move, equities reprice. Credit spreads widen, everything moves together, and wealth transfers rapidly from those holding long-duration assets to those positioned defensively. We have seen this exact sequence before. United Kingdom, September 2022. The government announced unfunded tax cuts. Bond yields exploded. The 30-year gilt yield surged by roughly 100 basis points in days. Pension funds faced margin calls. Bank of England was forced into emergency intervention. Prime Minister resigned after just 44 days. Sterling collapsed to near parity with the dollar. Real estate froze. Greece, 2010 to 2015. A decade of hidden deficits followed by a loss of bond market confidence. Greek yields surged from 5% to over 20%. Multiple bailouts. Total losses exceeded hundreds of billions. GDP collapsed by 25%. Unemployment hit 27%. Capital controls were imposed, and the wealth transfer was permanent. Japan itself experienced an earlier version in the 1990s. After the asset bubble burst, the government chose endless stimulus over restructuring. Debt exploded from 50% of GDP to over 150% by 2003, and now to 237%. For decades, this was masked by near-zero rates. But that era is ending, and January 2026 appears to be the break point. The Bank of Japan already ended negative rates in March 2024. They began reducing bond purchases. Markets were uneasy but stable. Then came the January election announcement. Then came the yield shock. Then came weak bond auctions. By late January, 20-year bonds struggled to find buyers. By early February, another weak 10-year auction confirmed deteriorating demand. This is not noise. This is stage 3, and stage 4 is starting right now. Japanese investors are repatriating capital. The yen has weakened sharply. US Treasury yields are rising, and global equity markets are beginning to feel pressure. Higher yields mean higher discount rates. The S&P 500 forward price-to-earnings ratio is around 22. Historically, normal is closer to 18. At current earnings, that implies roughly an 18% correction just to reach fair value. If yields continue rising, fair value drops further, closer to a 27% correction. That alone represents over $12 trillion in global equity losses. And that is before credit markets fully reprice. Credit spreads are already widening. High-yield spreads have moved from roughly 250 basis points to over 300 basis points in just weeks. If this continues, spreads could easily reach 600 to 800 basis points, levels seen in 2008 and 2020. That would trigger defaults, bank stress, and forced selling. Real estate is next. Mortgage rates follow Treasury yields. In Japan, mortgage rates have already risen from 0.5% to over 1.5%. Housing transactions are freezing. Prices are beginning to fall. In the US, mortgage rates are already near 7%. If 10-year Treasuries approach 5%, mortgage rates approach 8%. At those levels, housing demand collapses. Prices fall 20% to 30% in overheated markets. The wealth effect reverses. Consumer spending slows. Recession risk rises. This is how a bond market shock becomes an economic shock. And now we address the biggest misconception. People say Japan's debt is different because it is domestically held. That is false mathematics. Domestic or foreign does not matter. If yields rise, interest costs rise. And Japanese banks, insurers, and pension funds are not charities. They need returns. They will reduce exposure if risk rises. That is already happening. Japanese banks have reduced government bond holdings. Insurers are cutting duration. Another misconception is that the Bank of Japan can simply buy everything. They already tried for 8 years, and it stopped working. Inflation in Japan is now above 3%. If the central bank restarts unlimited bond buying, the yen collapses further. Imported inflation spikes, and political pressure explodes. The final misconception is that the election will solve this. It will not. No matter who wins, the fiscal direction does not change. Debt remains. Borrowing continues. Bond issuance rises. The problem is structural, not political. So what does this mean for investors right now? It means this is not the time for complacency. It means long-duration bonds carry asymmetric risk. You earn 4%, but risk 20% to 30% losses. It means equity exposure at current valuations is vulnerable to rapid repricing. It means emerging markets are at risk as capital flees to perceived safety. It means real estate and REITs face a double squeeze from rising rates and falling prices. It also means that short-duration instruments, cash equivalents, and defensive positioning matter more than yield chasing. And here is the uncomfortable truth. Once Stage 4 begins, it rarely stops on its own. It stops only when confidence is forcibly restored through massive intervention or when the system breaks enough to reset valuations. History shows this process unfolds faster than most people expect. The UK crisis unfolded in weeks. Greece unfolded in months. Japan's is unfolding in days. Today is Friday, February 6th, 2026. The election is tomorrow. Monday's market open matters, and the decisions made now, not later, will determine outcomes. This is not fear. This is pattern recognition. Japan's bond market shock is the trigger. The contagion has begun, and the question is not whether markets will reprice. The question is how prepared you are when they do. If you want to understand what comes next and how this spreads through US Treasuries, equities, and global portfolios, subscribe and turn on notifications. The next video breaks down the exact transmission mechanism step by step, because this is not over, it is just beginning.